Good morning to everyone. Thank you to our more than 100 participants who have registered in today's Work from Home Digital Series brought to us by FintechAlliance.ph, Global Data, Ignite, with the support from RCBC and AWS. We are also live via YouTube, and poll questions would appear on the right side of your screens. You can upvote and send in questions, making it interactive. These are some of the features of this platform. You can also download the presentation deck of our speaker right after the session. This is just the first of a series of digital symposia with the aim of enabling, empowering, and engaging our people during these extraordinary and challenging times. In almost 3 weeks of this enhanced community quarantine, we have been forced to rethink the entire structure of our everyday lives. Systems that have been the status quo for as long as we can remember were suddenly rendered invalid. The most difficult of all is that we have to figure our way through this chaos with the threat of hunger, disease, and death looming close. We may be apart right now, isolated from each other in the relatively safety of our homes. But this does not make us powerless. We are one in this industry, one in our mission for inclusive and sustainable development for Filipinos. And this stands true whatever hardship comes our way. I just do not know how many of you here would raise your hands excited for a long weekend next week. Imagine having a face mask as now being part of your daily must do and must have. Right now, there is no telling when or how this pandemic will end. But one thing is for sure, there is no going back to how it was before. The crisis has brought to light the weaknesses in our society, and it showed us just how vulnerable the great majority of our population. But this also showcased the Filipinos' resiliency and our unique brand of bayanihan, ang diskarteng Pinoy. This impacts to our economy and the financial services will be at the center of our discussion today. It will zero in on the COVID's impacts to banking and fintech sectors. The coronavirus indeed spurred digital migration. It forced Filipinos to go digital given the limited mobility. Through our collective efforts, I am confident that we will make it possible to thrive in the new normal that awaits us all after this crisis. I hope that the insights you'll pick up in today's digital forum becomes the to the foundation of a stronger and more inclusive Philippines. Let me now introduce to you our speaker this morning. He is currently Global Data's Head of Content for Asia Pacific based in Sydney, Australia. His focus is on the retail banking and wealth management market in Asia Pacific region. And as a Canadian, he had enduring interest in the financial services market of the Great White North. His recent topics of research have included a look at the wealth management markets in Malaysia, Indonesia, and Singapore. He has also been involved with a large-scale benchmarking project that compares the opportunity for wealth managers across some of the most attractive wealth markets around the globe, with a focus on the top markets in Asia. In retail banking space, he has covered such topics as AI in banking and mobile wallets across Asia and the growth of buy now pay later services. His team covers areas such as identifying desirable consumer segments, the mass affluent, and trends affecting the retail banking space in Asia Pacific. Ladies and gentlemen, please welcome Andrew Haslip. Thank you and keep safe.
Thank you very much. Excellent. We'll get into the presentation right away. There's quite a few bits of content here. For those of you unfamiliar with Global Data, we're a slightly new brand. We do research in a lot of different industry verticals, one of them obviously being financial services, which I'm from. But then some of the content in this particular presentation will leverage the insights that we get from the healthcare team and from the FMCG team and that sort of thing as well. So just note on that. And if you do have any questions on those bits of stuff, please do write them in the chat. Very happy to take them in the Q&A. I might not be able to answer it if it's about something particularly medical. I will definitely defer that to people who actually have doctor in front of their names, not myself. But if there's anything that you do have a question on, or want some more data on, or some clarification on, please do put it in the Q&A. As was mentioned, we're going to have a couple polls, and there will be a particular time I'll ask everyone to kind of like consider the polls, and I'll make sure that they're live then. And it's just to gauge kind of like your feelings around sentiment and business conditions and that sort of thing. Obviously, we're interested to hear what you guys have to say about that. So first off, let's go through a little bit of the agenda. So first off, we'll go into a bit of the medical stuff. I said we're leveraging from our teams in healthcare and pharmaceuticals. The economic impact, we have some very sophisticated economic modeling that goes on here, and this is based, I mean, obviously we're updating this quite a bit, but this is based on the first leading indicators that we can see for GDP and that sort of thing around the region. Then we'll focus a bit more on the banking impact, looking at business volumes, whether that's on the assets or liability side, what that's going to mean for profits, payments in particular being a big one that's going to be affected by this. And then we'll end off with a bit of a consideration what fintechs themselves can do, how it's going to impact them, and what opportunities there are for fintechs to help the nation and the banks get past this difficult time. So first off, the COVID-19 infection update. I think most presentations these days are going to have something like this at the beginning to talk about where we are when this presentation and when these numbers were considered. So this is a bit of a snapshot. Obviously that's a fast-moving disease, and we can only talk about what we have at hand. So at the time of writing of this particular report, the virus was in 177 countries, and closing in on 1 million. So literally when this was written, it was in the 800,000s, and I can see today that it's already past 900,000 around the world. The thinking and the economic modeling that was behind this report is basically when the U.S. has already been overtaking Europe as the center of the pandemic, which was over 190,000 at the time of writing at this stage. Italy was still the most devastated country, I guess, by the virus at over 11,000 deaths. And already the lockdowns and states of emergencies and all that are in effect when we've considered this as well. So moving on to the actual numbers. So this was the actual state of play when this was last touched, when the information in this presentation was last touched. So as I say, 177 countries. So the spread is pretty much there. It was below 900,000 when this was particularly written. The rate of increase from most of what we're looking at is like what's changed in the last week kind of thing. So 250,000 more cases. You can get into those numbers later. Here, just a brief breakdown of the top countries. So we do expect that to change in a bit, obviously, with a few of the larger countries like the United Kingdom coming up in the rankings a bit more, and obviously probably China dropping down a little bit more in terms of its ranking. But right now, those are the top countries for the virus, and this current state of play. Just comparing the virus's spread to other epidemics. So we have a couple of epidemiologists on our team and all that, where we it normally helps size the healthcare markets and such, and the direction of how much a particular drug could be sold or something like that. But it also is useful for they have very useful skills when looking at the actual look of how coronavirus is compared to SARS or other major epidemics. So it seems really bad right now, but if you look at it in terms of fatality, not nearly as bad as some of the ones we've faced recently. and also the reproduction rate. Obviously, something that we're all trying to get down desperately with by staying at home. If you compare it to measles and smallpox and all that, it's not quite as bad. Still bad enough though for us to all be taking this as a webinar from home. So now's I think the time I'm going to ask everyone to kind of look at the polls while we're looking at the kind of economic impact. If we could start looking at the first question. So the first question on the polls, and it's just on the right there next to the Q&A, is how you're feeling today as opposed to the early stages of the spread of the coronavirus. So um, one of the things we do quite a lot of is business sentiment kind of analysis, and so this is always very interesting to see how it changes over time. And there's a chart later on. We'll get into that as well. So yeah, definitely want to get your opinions on that. So first off, though, economic impact for a bit of a regional trend. So there's a lot of fear surrounding the impact, obviously, and really the virus is affecting economies in four main ways. Particularly early on, when it was centered in China, it was supply chain disruption, right? There was a lot of major businesses that obviously had factories in China, particularly around that area, around the Wuhan area, kind of, and they were disrupted. And that was a major impact in January to the rest of the region, and to the rest, and less so to the rest of the world, but definitely to the region. Then the second one, which hasn't quite been a big a play right now, obviously it was in Wuhan itself, illness and sick leave. It's definitely expected to skyrocket, particularly as probably next week and the following week. The third is obviously something that most economies now are experiencing to a greater or lesser extent, the quarantine efforts. So that's really what's doing the economic disruption right now, particularly as the supply chain disruption actually has lessened with China getting back to work. And then, of course, there's the follow-on demand shock as businesses fold and the unemployed cut consumption. So very much that there's different impacts, and we have to imagine how they're going to affect the economy differently at different times. So hopefully, once the medical crisis passes, we're just dealing with a kind of classic recession when there's been economic damage and then reduction in consumption and such, and then that will eventually happen. That is eventually in the good models, in the best case scenarios, what we'll be moving into. So that's kind of one of the key points that our economists have considered. So one of the things, just doing a quick scan around, obviously there's been a lot of economists that have cut GDP forecasts. Consensus GDP growth for 2020 at a global level is currently 1% now. And basically, there's an expectation that the global economy essentially went into recession at the start of March, when the bear market began in earnest on the stock markets. So that's typically when we are modeling the start of our economic shock, but also the start of the recessionary conditions to the economies. So entire sectors have temporarily shut. There's been a huge surge of unemployment. And this is one of the things that kind of set this particular crisis apart from previous crises. The very rapid uptick in unemployment has been kind of almost a leading indicator of recession in a lot of these countries, where typically it has actually been a bit of a lagging indicator. So that's a bit of a little different between when we compare, obviously, the global financial crisis to this particular crisis. But there has been a quite aggressive response in terms of fiscal measures from the governments. On average, what we're seeing is about 10% of GDP has been committed by governments around the world for the next 2 to 3 months. So that's quite a dramatic spend. In the range in Asia Pacific, it's been quite wide. So for the Philippines, it's estimated right now to be 1.6% of GDP. In Australia, we're spending 16.4% over the next 3 months on this crisis. So very wide range responses, and very different kind of outcomes in terms of the modeling for that as a result. So obviously a few points I want to cut through quickly. Interest rate cuts has been almost every single bank around the world, or central bank around the world has done that, and generally to little to no effect when it comes down to it. They've been relatively modest compared to what the central banks have done in the GFC, but it basically was, as I say, pro forma. It's expected that's going to happen, and it basically kind of clears the decks in advance of actual QE and more unconventional micro prudential kind of interventions in the market, which we're seeing as well now. So the early interventions were obviously focused very much on shoring up the medical response. So initial packages for fiscal measures to address this. I hesitate to call them stimulus, because the idea is a stimulus is to get people back to work. None of these measures are geared towards that right now. As I say, we're still in the early part where we have supply chain disruption. We'll be having much more illness and sickness, and the quarantine is what's causing our economies to go into tailspins. The current measures by all the governments that I've seen, and I've gone through quite a few of them, they're not designed to get us back to work. They're not designed to get us out of a recession. That is still to come. There'll be more measures that have to be committed later on to do that. The policy response right now is to put the economies into hibernation, and that's what they're geared towards. So we have to. That's why I try to be very conscious to say these are not stimulus measures. These are policy responses to the medical nature of the crisis right now. And one of, I guess, the key bits, so shutdowns and lock-ins right now are reducing monthly GDP by 15 to 33%, depending on the mix of the economy. So, for instance, in Australia, we have quite a large tourism economy and quite a lot of service economy. So it's closer to the 33% here. In some markets, it's like Singapore, it's closer to the 15%. So obviously, unfortunately, we think the lockdown in Philippines will be closer to the 33% part of the range than the 15%. When looking at the actual impact right now, so the modeling in terms of, so we call it stimulus here because it's a short way of saying it, but so the policy response right now for the top affected markets has been quite broad. So the largest policy response right now is from Germany, which has had quite open-ended kind of commitments to fund business and wages through the crisis time. But really, there's been quite a bit of spend all around, and these have been ramping up, and they'll continue to ramp up. In the case of those like Italy that has been spending a relatively small amount, that is definitely not sustainable, and that's definitely not gonna persist. But you can see the actual policy response in Asia Pacific was relatively low so far. There's a few reasons as to why that's the case. In some cases, the institutional capacity of government to spend that money is not there, and in others, it hasn't actually been a requirement as so far. So that's the main thing. Obviously, one of the key things that we've monitored and kind of factored into our forecasts, and for both the banking side of things as well as the economic, has been the absolute collapse in a lot of the markets. In particular, the crude oil market, as a lot of economic activity has ground to a halt, and as well for other reasons just devoted to the tiff between Russia and Saudi Arabia, but it has resulted in quite dramatic declines of almost 70% in the price of certain crudes. But right now, there's actually a lot more volatility than you'd think for the market. It's gone up quite a bit. I'm thinking more of the stocks around Asia Pacific. there's been quite a lot of volatility, both up and down over the last 2 weeks. And that's really just because they're investors really are trying to gauge where we are in the crisis. There's an expectation that we have not hit rock bottom yet, and so that's what's kind of driving the up and down. No one knows where the true bottom is as of yet. Um, the other key kind of indicator that we're looking at pretty intensely has been the unemployment. So we can get some really early indications from some of these more developed nations in terms of unemployment rising in those markets, and it has been quite dramatic. By contrast, the global financial crisis took 6 months to drive as nearly as many increases in the jobless rate over that period. So that's quite dramatic to see that in 1 month. Really, it's quite important. But generally speaking, we anticipate the 1 month increase of unemployment to be roughly 20% of the unemployment rate. So that's pretty dramatic for all markets. So what does that mean in terms of GDP? So there's basically a lot of recession going on, and as I say, we usually backdate that to March 1st as being the time of contraction. So there's still a lot of range in terms of the estimates. For the Philippines, we still think there will be growth even in the most negative scenario. So the Philippines is just down at the bottom there, with our consensus forecast at around 4.3%, which is a reduction, quite significant reduction from what we were expecting. So that's about a third of growth taken off the year total. But obviously, as you're seeing, not nearly as bad as what the major export markets kind of are going to be experienced around the world. So key ones obviously there being China. One of the reasons why there's quite a lot of variation there is because there's still a lot of uncertainty as to whether China will see another outbreak again this year. Done a very good job of getting back to work and getting control of the virus so far, but because the rest of the world is so uncontrolled as of yet, it means that there's a very high degree of probability that they will see another outbreak imported from abroad, strangely enough. And that's really what's seeing the negative figures there. The U.S. As well, quite a big kind of spread on their figures, and unfortunately, quite a bit of downward spread. And that's just due to the fact that they've had a few policy blunders getting into it, and that it might be a fairly protracted kind of lock-in period for them, unfortunately. So, which obviously has this is what's really driving the negative global figures. Those two markets there, the negatives in China and the negatives in the U.S. is really what's driving the poor global figures, because obviously with those two economies in lockdown, we're not going to see a lot of growth around Asia Pacific. Here we just did a quick trolling through some of the forecasts that some of the leading economists that we track in our Twitter feeds and all that. And as I say, recession expectations have heightened quite a bit. Basically the view of the economies really have to change to something that's more on a war footing. And it's quite an interesting one, because it's not something most of us, I think, have seen in a long time. So I think we have. I think we probably talk about the results of this poll now. So basically, quite a bit of concern there. So 74% saying very concerned. 26% slightly concerned, and then obviously no one actually unconcerned or not very concerned at all. So you pretty much mirror what the leading economists are saying out there right now. with a lot of potential for downside. Although there's a possibility that we can still get through this with some growth for the region. Maybe not some of the more developed economies out there. And so we're going to start, since we're going to be focusing a bit more on businesses here, we'll start with the second question as well. So the second question is, how optimistic are you about your respective companies, whether that's a fintech startup, a more mature fintech, or a big banking player yourself? How are you feeling about your growth prospects? Let's say over the next 1 to 2 years, shall we say? No, obviously the growth prospects probably for this month are not great, but do try to look ahead a little bit and give us a view on that as well. And I'll let that play for a little while and go through a few more slides as well. So sorry. So companies, when we also, one of the things we do in our research is we take in everyone's annual reports and quarterly reports and all that, and scan them for what they're talking about essentially, and we look at that, and we can identify a couple of hotspots in terms of the companies that we're tracking, and we track thousands upon thousands of companies. Basically, any company that has to produce reports for stock exchanges, we take their reports and run them through our AI and scan them. So when we're looking at just those reports from the last month, the number one kind of mention sector, companies from this sector, is the technology sector. Number one, absolutely. Very close behind that, not surprisingly, is the pharma countries that the pharma companies that we're scanning, which I hope for a good reason. They're hard at work on the case for a vaccine and treatments and such. I'm absolutely desperately hoping on that. But really quite interesting, I think very striking for us, is the financial services sector is the third most, I guess, concerned sector of the economy for the coronavirus, for COVID-19. And I think that's quite striking. And it's from banks that we're seeing across the world, really, and insurers. So this is financial services writ large. So we're seeing insurers in there, whether they're health insurers directly, or whether they're actually reinsurers and general insurance players, because they're still invested in the market. They're still going to see a big hit to their business lines as well. So I think that's quite important to note, is that really financial services is on top of it, and quite focused on it. When we look at, so this is a poll that we run. So this is why I was talking about the polls earlier and wanted to get a few of them run. So this is a poll of business executives. So CXX kind of suite people. And we're just looking at, and this is across not just financial services, but across across our kind of panel of industries that we cover, and we cover 16 of them, so it's quite a few. But it's a general kind of global business confidence barometer, and then you can just see how that we previously optimism was pretty good, but there was a spike in pessimism, obviously, for growth prospects. That has actually since been alleviated a little bit. In the early stages of the breakout, there really was, that 1 week of almost free fall on the markets, and kind of scramble from government to address things. There is a little bit more optimism that government has actually got a handle on what we're doing in terms of the coronavirus right now. So that's pretty good as well. So I just wanted to compare the results to our poll. So number two, how optimistic are you about your prospective company's growth? 14% quite optimistic, or very optimistic. 62% optimistic. Almost 10% in the middle, and I'd say almost closing in on 20% for pessimistic. So I think a little bit more optimistic in the Philippines than we are seeing around the world, and I think that speaks to a very much the position that obviously the Philippines has relative to the outbreak let's say the United States and that controlled spread that they have right now. So that's kind of I think a bit of a encouraging line and a little and a very encouraging data point to look at. All right. So the next, so I'm just going to close that poll and then start up the next poll so we can have that going as well. We'll let this run until probably for a couple of sections, but just I would just want to read it out for you guys. So, as founders and businesses, what are you doing is important right now. So now is the time to create growth, new employment opportunities, and solve the world's largest problems. What are you considering as options for you right now? So just have a look at that, and I'm just going to go through some of the banking impacts and trends that we're seeing around the regions and specifically more for the Philippines. So when we reviewed the policy impact in the Philippines, obviously there's a couple of things that have come out. Interest rates have been cut. Same thing around the world. Also, not too terribly much enthusiasm for those interest rate cuts and expectation that they're going to stimulate the economy in a massive way. Um, and really that has resulted in obviously a package of fiscal measures brought out by the government to stabilize the economy in this period of lockdown. So um, first off, though, looking at kind of measures around lending. So we always look at mortgages first. In common with a lot of banks around the region, commercial banks are offering payment extensions and holidays. In the Philippines, it's been relatively small. In Australia, for instance, we have up to 6 months of deferment and recapitalizing loans. From what we've seen in terms of monitoring the announcements of the banks around the Philippines, it's been more in the 1 month to 2 month period. But the expectation of, I guess, the lockdown period in the Philippines is a little bit different from what we're experiencing here and in other markets. So that's probably some of the reasoning behind that. In terms of consumer credit as well, same sort of kind of payment extensions that we're seeing for qualifying credit. And once again, this is very much similar to what we're seeing around the region, the banking sector stepping up in this way, and a little bit more lenient terms for essential workers, whether it's in the medical or in essential workers fields, and no fees being charged there. SME credit being treated very much the same as the personal credit. One a little bit different there. There's a lot more direct business support being offered by governments around the region compared to what we're seeing in the Philippines. In terms of bank funding as well, no direct support as of yet from the government to stimulate lending or support lending to certain sectors of the economy. This is very much something that we've seen quite a lot of in other markets. And it's probably something that we're going to see in the Philippines should the quarantine period go on for longer. In terms of financial markets, the central banks obviously plan to purchase a large slug of government securities to support the program. This is very much in line. I mean, normally this would be a very dramatic kind of intervention in the market. In light of what other countries are doing, this is very much run of the mill, very much what reserve banks and central banks around the world are doing explicitly, not necessarily with even a banded amount of money that they're going to bandy in there. And not just, it's interesting that the interventions really here just in the government securities market. In other markets, we're seeing this kind of intervention spreading into ETFs, into REITs, into corporate bonds for sure. A lot more pervasive intervention by other governments. In terms of macroprudential, this is definitely something that we're seeing as being a bigger flavor in this crisis compared to other crises, namely being the reduction in reserve requirements to free up more balance sheet essentially from of the commercial banks to lend to the economy. This has definitely been something that a lot of central banks around the world have been very favorable towards. And it is one thing that we see as being a big support to the lending activity in the Philippines and around the region and all that, is that there's been a marked reduction in kind of the macroprudential tightening that has gone on for the last about, I'd say, 5 years or so. And then, of course, the direct fiscal measures, the expanded unemployment benefits, and the temporary support for casual workers, something that we have seen in other markets as well. So that puts the government response, I think, very much in line with what you're seeing in other areas. Um, I got to say, just comparing, the Philippines to other markets in and around the region and around the world, higher debt markets have been more aggressive, I think, in terms of their loan deferment plans and their action to stimulate the lending in the economy. So, for instance, speaking from a very high debt society, Australia, they've been quite aggressive, and you can see that in terms of the numbers that the central bank has committed, the variety of programs that they've set up to encourage lending to SMEs as well as corporates, and the deferments and support offered in the retail side of things as well. Generally speaking, most of the provisions come through financial hardship programs, and it's kind of an interesting trend. The most of what we're seeing is going to be recapitalizing loans with missed payments or deferred payments in some form or another. So while we expect gross lending to be down quite a bit in 2020, the balances outstanding are actually not supposed to anticipated to be drifting down in quite the same way that you'd expect with a collapse in gross lending, because a lot of these loans are going to be recapitalized and be larger than they were in 2019. So that's quite an interesting one, and it's something we've had to take into account in our modeling. Yeah, so I think that's probably a good look at the policy impact. What it means in terms of what we look at for those markets most at risk from the coronavirus, and this is looking at just purely in terms of the lending risk. We look at a number of factors. We look at the percentage of self-employed in the market, those with kind of financial buffers, so savings up, have to have at least savings of $15,000. Do they have a personal loan? Do they have mortgage debt? And how severe the economic lockdown has been in the country. And if we take all those things together, the Philippines is kind of middle of the pack when it comes down to it. Not nearly as bad as quite some other countries. And you look at a lot of important trading partners around the region, also not too bad. But unfortunately, the main drivers of global growth, the U.S. and China, not looking terribly great in terms of the impact of the coronavirus on their conditions. And that's something that's really going to be the overarching overhang later in the year, will be the drag that the U.S. economy will have on global growth, and potentially China if it does relapse as well. So great that the Philippines is kind of middle of the road there. When we look at in terms of just if we strip away the actual caseload, because that's very fluid, that's going to change quite a bit, undoubtedly, and just look at who will be hardest hit toward in a disruption to the global economy. Unfortunately, the Philippines comes out quite a bit stronger than other markets, because of the percentage of self-employed and the lower savings to more modest households. So that's one step of concern. What we've seen in terms of the response of the banking sector. So we've already talked a little bit about what they're doing for consumers, in terms of their own businesses. There's essentially been a drying up of uh, expansion plans. So compared to just over the course of March, we track the number of jobs posted by banks around the region, and the trend has been quite dire over the course of March, with really once again that midpoint in the month really being where the uh, the brown stuff really hit the fan, shall we say? So around the 16th really being the point where in which a lot more banks decided to shelve any expansion plans. So there was a spike at the beginning of March, and then another spike in the middle. And since then, we've seen very few job postings being put out there by any of the banks. So the closing volume more than doubled. So that's why we have a net loss of 16% of active listings in 1 week. And then, but if we analyze it a little bit between what kind of banks we're doing this, we see there's really no difference between domestic and local brands and foreign groups in the markets. There really hasn't been any change in terms of hiring between the two, so that it's basically trending the same. Sometimes we do see a slight difference there. Now going into the brass tacks of it. So this is Asia Pacific overall growth for key retail banking lending. So the solid lines there are the pre COVID-19 impact assessment, and then the dotted lines really are revised assessments based upon initial GDP figures and impacts on the markets. So we were anticipating a pretty good year for credit cards, for instance. That's going to drop considerably. It's by quantum, it actually drops the most of any of the personal lines of credit that we see, and that's something that mirrors essentially what happened during the GFC as well. Looking back on the GFC has been a great help in terms of helping our modeling this particular forecast. Not a perfect representation, but it has helped and shown us how some markets will adapt. But as you can see, all lines of business will suffer in the forecast. The one that will suffer the least, oddly enough, will be mortgage growth. So we still anticipate that will see some growth over the year in terms of balances outstanding as the mortgage market restarts again in H2 after going into a deep freeze for the first part of the year. And that really reflects the strong kind of developmental potential of the region, rather than the fact that there's going to be a rapid recovery or anything like that. When we look specifically at the Philippines, it's a slightly different pattern. Once again, we're seeing drops in all lines of business, obviously, but the credit card lending is actually the one we anticipate is going to hold up the best over the course of the year. Some reasons for that really is that it is going to be, unfortunately, the tool of choice when having to maintain consumption in the lean months. We do anticipate that a lot of households will turn to the credit card as the first port of call for maintaining their consumption. It's also a little bit of a turn to the fact that there will be a lot more consumption through digital channels. So buying things online, whether that's food or whether that's actual goods and services, that's going to fuel a bit more growth in credit card balances over the year as well. So that, I mean, that in theory is actually a good thing. That people were just turning to use their credit card as a payment tool more, and that will just draw a little bit more growth in terms of the balances outstanding naturally. The other two lines of business, mortgages and personal lending, absolutely going to crater as well, with really no massive recovery for personal loan growth in the short term. So we'll revise these as numbers come in on a quarterly basis. But the recovery, if you look at how the economy has reacted to previous drops and recessions, the recovery has been slowest for personal loans compared to the other lines of business. So that's just something that everyone's going to have to take into account. If you want to see lending recover quickly, you got to go for credit cards and mortgages rather than the larger personal loan market. So what does that mean for revenue and profitability? So I guess in words that will surprise no one, it's going to drop quite a bit. So there's a couple of reasons for that, mainly because all drivers of profitability are going into reverse for this year. And what does that mean in more detail? Fee income will fall, basically driven by the fact that there will be overall a reduction in consumer consumption. Um, there's been there's a lot of attempts by the government and by a lot of support from the banking sector to keep consumption up, of course, but it's going to fall nonetheless. In times of uncertainty, households draw on their horns and will put off any non-essential consumption essentially, and that's gonna hit the banks as well. Um, NPLs will rise as well, so money coming in will go down due to less volumes going through for certain lines of business, notably like mortgages and such. But NPLs will eventually start increasing, even with all the easy money on offer, essentially, the measures taken, the financial hardship measures taken by the banks, they will inevitably rise towards the second half of the year, particularly in sectors that have been hard hit, such as retail, travel, tourism, and the entertainment sectors, of course. That's just gonna happen. Our expectation is that there'll be a 211% increase. This is a global, or sorry, this is a regional figure. The 211% hasn't been specifically modeled for the Filipino market yet, but we do anticipate that NPLs will more than double by the end of the year, despite the deferment terms. Short term as well, costs, unfortunately for banks and all financial institutions, will rise. Just setting up people from working from home, VPN issues, buying technology to better enable distributed and remote working. That's gonna cost directly, as well as kind of the indirect costs of having people distributed and working in patterns and processes that they're not familiar with. There is going to be a drop off in terms of efficiency per employee as well. So that's something that's just going to happen. We have to kind of accept it and work to address it, with obviously technology and new ways of working. So that's just something that's going to happen. Overall, what's that mean for the banking sector in the Philippines is, based on figures from the end of 2019. We had 287 billion in terms of profit. This is not just retail banking. This is across the entire banking sector. We anticipate a 76% reduction in profit, although there still will be a profit. We are still calling for a profitable in aggregate banking sector in the Philippines, which is not something that we're calling for every market. Let's just say, so that's modest profit still, but still a profitable one. So that really does, I guess, speak to the fact that there has been quite a lot of effort made to increase efficiencies over the last few years, and the actual shift towards digital in a lot of banking will allow them to maintain that revenue and that profit pool. Some of the key takeouts: banks have been keen to avoid pushing customers into default for obvious reasons. Not first and foremost being that it's the kind and right thing to do, but also for the havoc that causes, obviously, to the balance sheet and the need to reserve more against those kind of loans as well. Costs will rise. One of the interesting things, and one of the more important things to note, call centers have kind of seen a big resurgence in terms of importance as branches have had to close or reduce hours, and people just don't want to go into them at all. But they also are one of the worst workplaces for pandemics and the transmission of the virus. So that's a key one to work around, and just generally around revenue and NPLs increasing. So that's basically looking at taking in money from and offering the credit, but we also like to assess and have a look at the other side of the balance sheet, the taking on of liabilities, and bank funding essentially. So this is what this particular slide's all about. So the kind of column chart at the top there is our forecast for retail deposits, bonds held by individuals, equities held by individuals, and mutual funds, which is on there, but it's just a really tiny market in the Philippines. So that's kind of all the funding that we see, the way Filipino households save and invest. And one of the interesting things that we're going to see for 2020, and definitely something not replicated around the world, is that the aggregate number, the aggregate savings should actually go up in the Philippines. One of the key reasons why that's the case is, first of all, that the actual average family is very unexposed to the products such as the mutual funds and equities that have seen a big swing in terms of their value down, obviously. So that's in a lot of other markets, particularly developed markets, that is to reduce aggregate household wealth in 2020. That's not necessarily a problem for the Philippines as much because that's a very small part of the market. There's actually quite a lot of bonds, and particularly for a developing market, and obviously a huge amount of actual wealth is devoted to the deposit market. And that is really what's driving the growth, which is our revised forecast for household savings and investments is the lighter bar there, the bar in the middle. So from 2020 to 2024, you see that lighter bar kind of outpacing the old market. And so really what we see as a lot more money coming into the deposits market, into the banking system. A couple of reasons why that's the case. Obviously, the other asset classes have got hammered over the last little while, and so those with money that would normally put it into the equities market or into a mutual fund will instead be putting it into deposits. There's another reason, and it's quite interesting, is a lot of currency that would normally be used for payments and to buy things and such will be instead deposited, taken out of you know um, species taken out of circulation and instead put into the banking system as a deposit so that they can use it as a digital payment in some form, whether that's a card payment or like a mobile wallet kind of payment. So that will just mean more money coming into from out of the, I guess, the informal savings um, um, market and into the formal savings market, which is what is really going to drive some growth in the short term for Filipino savings. So that's actually a real big opportunity to capture that and deal with that. It is actually not something that every market's going to see. Not even every market around Asia Pacific is going to see that kind of growth in terms of household savings and investments. But unfortunately, it sounds really good. Yay, in aggregate the Filipino households getting more wealthy. It's not actually true because it's just we'll be better able to see it, and it will come into the formal system more rather than being in the informal system. So that's a little bit of a difference, and it doesn't necessarily mean the actual household wealth is going to go up in a big way. So just FYI on that, because I know it does look a little bit odd that, oh, you're anticipating more money in the Filipino market. Not exactly what that means. um, when we look at so that's kind of the retail view of things. When we look at more of the more affluent kind of investors, you can see that they're definitely going to get hammered, and so this is definitely going to affect large deposits and essentially VC funding and such as well. So there was a decent amount of exposure to equities, 22.9% in 2019, which is what this figure relates to at the bottom. These charts at the bottom. So you can see that there's been a fair amount of exposure to variable products, which obviously will be dampening the enthusiasm of these investors going forward over the next little while. So in particular, those were big into equities and commodities, obviously being arguably the worst asset class this year, and definitely on track to be the worst asset class this year by far, with the collapse in the oil price. But even things like property is gonna have a normally a fairly safe and solid asset class is gonna be trending down in terms of value as well. So that's something that we have to take into account when looking at the overall funding mix of the banks and fintechs. So when we look at the kind of impact a bit more on the payment behaviors, I think there's a lot of text here, and I'll let you get through it. A lot of it's talking about trends we're seeing in other markets as well. One of the important things is obviously in-store payments are going to um, go down quite a bit, particularly for non kind of essential purchases. So aside from supermarkets, your grocery purchase and pharmacies. Electronic payment tools are obviously going to see a lot more action, especially at contactless tools. But in certain markets, that's a little bit different. In much of what we're seeing in Europe, for instance, they've been making moves to facilitate it. There's been a lot more contactless card usage. That's not something we're going to see as much of in the Philippines. True, we do expect it to increase. So we do expect payment card use, but this is going to be much more of an affluent behavior rather than something that we're going to see across the piece. Among less banked segments of society, what we're anticipating is a big increase in mobile wallet adoption. Which was already increasing. So our trend forecast for the Philippines for mobile wallet usage was to increase by 113% in 2020. Which is a pretty dramatic figure, and that's based on survey data of people. Basically, this is what people have been telling us when we survey them, how many people actually want to use this technology but don't currently do it. So that's what's really driving that forecast. That right now to us actually seems conservative, and I know it sounds sounds a little bit dramatic, but that increase in mobile wallet usage is going to be the baseline for us, and we're going to get our survey data very shortly for 2020, and I'm anticipating that the penetration rates and the usage rates should shoot up quite a lot. And a lot of that is just how different segments of society are able to access non-cash payments. And for many, the most convenient, the easiest to start using is going to be those mobile wallets. And so that's really going to be, I guess, a big flag for the growth potential and new areas to consider for every player in the market, not just those who are already involved in mobile payments. So here's just a few reactions that we've seen, more notable ones where either the banking clients told us about them or we've noticed it in the news for reactions to lockdown essentially. There's been some varied kind of rollouts. What we're really seeing quite a lot of is that some banks are taking this as the opportunity to ditch more branches. So obviously closing them in the short term, but also kind of noting that they're not necessarily going to reopen in the long term. That's something that is just going to increasingly happen. Because one of the main kind of stumbling blocks for growing digital usage has always been that there's a great alternative, and I'm used to it, and that's the branch. So that's going to be thrown out the door. But I'll let you guys get through that. I mean, the slides will be available. You can read through those later. So the next bit will be on the fintech kind of side of things. I'm just going to close the current poll as well, so that we can just look at that and we'll get through that. So I think the first just go through the poll results as well. So what are you guys considering in terms of new opportunities and to solve the problems? Number one response was all of the above, so that's kind of good. It's great that everyone's kind of looking at all options, but we'll just go through some of the options from top to bottom. So focusing on improving the product and service, 25%. So that was their number one focus. The next most important was structural solutions to partner and generate revenues. So also quite a good one there. And then tied for the bottoms, grants and stimulus, and relying on research to find opportunities. So that's definitely second tier when it comes to it. So really a focus on products and services and partners. So that's actually quite an encouraging result. So when we look at the impact on the fintech sector, There's a couple trends at play here. I think we have to look at. So initial impact obviously is going to be negative. There's no getting around it. It's not ideal business conditions for any small business, and that's really I think what we have to look at. A lot of the fintechs operating currently, particularly in and around Asia Pacific, is that these are fundamentally, in the first instance, small businesses, and small businesses are going to be hammered by the outbreak, and we just have to accept that. But if you look a little bit longer term, out of the next 3 months, let's say, it is definitely a positive kind of outlook. So what we have here, one of the things we do is track fintech deals around the world. And this is just some of the tracking that we've done. I've just put it up from the last 5 years. And as you can see, the overall trend has actually been going up. Not always, not in a solid line, and certainly there's been some extraordinary deals that have boosted 1 or 2 quarters overall. But generally speaking, the fintech ecosystem has been growing over the last 5 years. Yeah, I know there's been a lot of little talk about how it's dropped off. It's really is not the case, and you can't just compare it to the peaks around like when a big deal has been done as well. Some key trends that we've noticed overall, particularly in Asia Pacific, payments figures as an enduring part of the ecosystem. 29% of deals are still done in the payment kind of technology, whether that's online or kind of offline payments. They're still in that area. And then the next biggest one is still in the retail banking arena. So that's kind of interesting to note. Yes, funding will be down in H1 compared to H1 last year, or even H2 last year, because we ignoring the spikes and all that. Deal volume will also decline. One of the things we have to remember as well is VCs are being investors themselves have been disrupted by this. As businesses themselves, they've been disrupted and less able to actually make an investment, even if they wanted to. The remote nature of the economy right now makes it a challenge for them to investigate worthy targets and commit funds. So that's just something we're going to have to work around, and that's just an issue we all have to deal with. Once again, there are many fintechs still micro SMEs, and so exposed to this in particular. Payment and remittance tech will still be disrupted, but will benefit overall once kind of new digital arenas open up for payments. When we look at banks and other large FIs, the partners of a lot of these fintechs, we need to caution them to make sure that they are supporting their fintech partners in the same way they would as if they were lending money to these small businesses, as if they were customers themselves. You have to understand that there's cash flow issues that a lot of these fintechs are going to have as a result of the disruption. And if you believe in the technology that they're peddling, there should be additional support that you as a big player in the market can give them to ensure that they come out of this on the other side. Fundamentally, though, the coronavirus is gonna spur digital migration, particularly in the payments area, but in other areas as well. So that's gonna open up more opportunity for fintechs. As I say, fintechs can help with that. Not only are banks increasingly just having to cope with going digital, but they want their customers to go digital as well to be safe and to still be able to use their services. The best way that we found so far for a bank to do that rapidly is to contract with a fintech with a superior product in that area, and that's really where a lot of fintechs are going to be able to have a lot of impact on the market and a lot of potential to grow and shine over the next 3 to 6 months as well. So fundamentally, though, a lot of opportunities opening up for fintechs as there's just a lot more digital coming into the economy overall. fundamentally, the first thing, the first step in addressing any of that opportunity is addressing the security issues. When we talk to bank executives, and so these are CTOs and CIOs from leading banks around the region that we talked to last year, their number one concern is always cybersecurity, whether that's security of their own networks or ensuring security of their interaction with the clients, with the customers. So that is fundamentally, I'd say that the first instance, the first port of call for any fintech looking to tap into any of the opportunities that the coronavirus is going to throw up is get in there with a security solution, or be working in the security area first. And then there's also, of course, going to be the payment area, the workflow area. Particularly right now, a lot of banks are definitely interested in efficiency tools, workflow tools, and all that to help them regain that productivity in the back end. But obviously, addressing the e-commerce area. Definitely an area that we see as growth over the next little while. Digital banking tools, being able to give a lot of customers are going to be using mobile and online banking tools for the first time over the next 3 to 6 months. And that is a key time to basically win over the customers to this channel. If it's not top notch, then the bank obviously risks losing the customer entirely. So fintechs that can bring to market rapidly extra mobile and online functionality that is going to wow customers really have a great story to be telling banking partners at this time. And finally, like longer term, I think obviously this crisis is creating a lot of unemployed people. The credit market is going to be severely disrupted by the fact that there's a lot of non-standard risks now going to be coming into the market, whether that's in the Philippines or around the world. Most of the digital originations for credit that we've seen in the market rely upon the person being a very standard risk. That is no longer going to be a majority of the market. Basically, going forward, a lot of the market is going to have arrears. A lot of the market is going to have missed payments of some form or another, some restructuring or whatever, what have you, on their books. And so fintechs that can help banks sort through that in a constructive way, so they can still lend to potential customers in a digital channel, then those are the ones that are really going to shine over the next 1 to 2 years. So I guess looking at from the top to the bottom, most immediate is cybersecurity, down to the longer term, looking at providing alternative credit scoring, being able to analyze alternative data sets. That sort of thing is definitely going to help out and shine and be an opportunity going forward. So that's essentially. I know I've gone a little bit over time in terms of the presentation, but that's essentially our view right now with the market and the state of play for the Philippines and banking and fintechs. I think we have a few questions. I might actually take those and get back to you. Yeah. Yeah, because there's some of them actually might be more geared towards our medical team rather than me, particularly ones around mortuaries. So that sort of thing, I might wait for those. But yeah, definitely, I will get back to you on those. Expect emails from me, and please do download the slides. And if you have any further questions, please reach out, and we will get in contact with you. As I say, we are just about to get some new consumer data. So 2020 data, honestly, be revisiting these stats as new data comes in, because it is very fluid right now, and we'll have to do another update, I'm sure. So thank you for your time.